Welcome to this lecture on non-residence. Okay, so when we talk about non-residence, what is the best starting point and what is the most important starting point for us? To start talking about gross income. Because gross income determines, remember, when we talk about gross income and any of these things, we're only talking about it ever from a South African tax perspective. We don't know what other countries do. They might call it something else, even if they call it the same thing. I just want to remind you that we're always just talking, when you talk about any tax, we're always talking about it from a South African perspective. It's important, especially when we're looking at non-residents, because there's other countries and things involved, that you don't get confused when you're looking at a scenario about who they are talking about. Now, when we look at gross income, and we've looked at gross income for residents, we know that residents are taxed on their worldwide income. And the reason for that is because if you look at the definition of gross income, it does not mention anything about a location or a source of the income. It just says that during the year of assessment, the total amount in cash or otherwise received by or accrued to a resident, excluding amounts which are capital in nature and including your special inclusions. So it doesn't say where it must come from. So therefore, we have a situation where if a South African goes and he sells pies in Johannesburg, he'll have to include it in his gross income, the income he makes. And if that same South African goes to America and sells pies in America there, he will also have to include it in his gross income. So when I'm saying he must include it in his gross income, it's important for you to remember I'm saying he must include it in his South African gross income. Now, when we are looking at non-residents, it's also important for you to just understand that we are looking at the Act in its raw form. We get things called double tax agreements. So I'm just mentioning it now, double tax agreements, which are agreements between two countries on who should get taxed and when and where. So in reality, my example I used where I said a South African goes and sells pies in New York, there might be in the double tax agreement that it says if you do something like that, that person must be taxed in New York. But we don't look at that. We study the Act from its raw form. You do look at double tax agreements in your CTA here, and in questions they can provide you with them, but they'll always have to tell you and give you an extract from the double tax agreement. So it's not as common to see. Much more common is to understand what we're looking at here is the Act in its raw form. So we're saying if there was no double tax agreements, this is how South African tax would work. So South African residents are taxed on their worldwide income. Now, non-residents, which we're looking at now, get taxed on their income from a source in South Africa. So, just think about it logically. If an American sells pies in New York, can we tax them? Just think about it for a second. It makes no sense. Because why? It's an American, so it's got nothing to do with South Africa, and New York has nothing to do with South Africa. So the things that an American does in New York, we can't tax. But now that American comes to South Africa and sells pies here, what is that person doing? What is the theory around tax? Why should we tax that person? The theory around tax says he's coming to South Africa and he's using our resources, and therefore you should contribute. Okay, so if you go and look at the definition of gross income in section 1, remember we've already looked at it, but if you go and look at paragraph 2 of it, paragraph 2 talks about non-residents, and it's a little bit different from what it says for residents. Mostly the same, there's one change. So it says, for non-residents, so usually the gross income definition says for residents, so that's one change. So for non-residents, during the year of assessment, it's the total amount in cash or otherwise received by or accrued to that non-resident from a source within the Republic. And that is the biggest and most important difference between the gross income definition for a resident and a non-resident. That it must be from a source within the Republic, and it excludes amounts which are capital nature. So it's exactly the same definition. All of those principles that you looked at, received by means you've received for your own benefit, accrue to means you've become unconditionally entitled to it, capital nature, the tree versus fruit, the Visser case, all of those things are the same. Okay, it's just that it must be from a source in the Republic. And the Republic means South Africa, guys, just in case you are unsure. Right, so when is a person a non-resident? How are we going to know when a person is a non-resident? So obviously, if they tell you in a question it's a non-resident, that's quite logical, then it is. But how it works is we look at the definition of a resident. And if a person does not meet that definition requirements, then that person is a non-resident. So when are you a resident? Can you remember the definition of a resident in section 1? Says for a natural person, it is when you are ordinary resident. And that's where we had the Cohen and Cattell cases. So those are the ones which says South Africa, you're a resident of South Africa, ordinary, if it's a place you return to from your wanderings, or the place that you call your real home, right? Or the physical presence test. So if you tick one of those off, then the person is a resident and therefore not a non-resident. But if both of those are not met, then the person is a non-resident. Remember, you're a resident if you're not a natural person, so if you're a company, if you are incorporated here, so that means you were formed in terms of the Companies Act of South Africa, or if your place of effective management is in the Republic. And I'll have to indicate that to you. So if you're not a resident, then you are a non-resident. Okay, so just again, guys, before we jump into all the little details and things, we're just talking about all the different, just understanding in general how a resident and a non-resident works. I actually want to just go back, when you're at the introduction, I just want you to make a little note for yourself somewhere also here and say, you'll see it is apparent from everything, but just a little note to say note. Non-residents, or the same tax rules apply to non-residents. The same tax rules apply to non-residents that apply to residents. So example, same deductions, allowances, tax tables, etc. Okay, so what do I mean by that? If you're a non-resident and you earn South African dividends, for example, what do we know about South African dividends, local dividends? They are exempt for a resident in terms of section 10(1)(k). They're also exempt for a non-resident in terms of section 10(1)(k). The interest exemption, same for the non-residents that you get. General deduction formula. If a non-resident comes to South Africa and runs a little business here for a while, and they're still a non-resident, and they have gross income, they can claim things under the general deduction formula. They can claim capital allowances. So everything works exactly the same. But, just one comment. Look out for the special sections that only apply to non-residents. And also, guys, there might be some sections in the normal act that also says this only applies to residents. Then you know, obviously, it doesn't apply to non-resident. Okay, but all of these special sections that we're talking about, that's what we are discussing in these notes. Okay, so let's talk about immigration and immigration. So first up, in case you get confused with it, immigration starts with an E. It is when you exit South Africa. Immigration starts with an I. It's when you come in to South Africa. So if I immigrate, it means I'm leaving South Africa, and if I immigrate, it means I'm coming into South Africa. So you just obviously need to read it perfectly. Now, if a resident immigrates, that means they stop being a resident and they become a non-resident. Okay, I'm just going to show you on the next slide just visually how this works. Now, before I even continue, guys, just on this note, this slide is something that you'll study in a lot more detail when you're looking at capital gains tax. So if you have studied CGT, then this is good revision here for you. If you've not studied CGT yet, then study this more under CGT. Okay, it is a little bit more complicated and it takes those rules into account. But what I want you to see here, if a resident immigrates, they become a non-resident. Now, what is important about that? That means during the time, so this could be, remember, a tax year for a natural person starts on the 1st of March. And the end of the tax year is the 28th of February. Now, let's say this person on the 1st of November immigrated. Then it means from March until November, you treat a person as a resident. They tax on their worldwide income. All of the rules that apply to residents apply. From the 1st of November, so the date of immigration is the 1st of November, so that's when the person stops being a resident and becomes a non-resident. From then you apply the non-resident rules. So the person only gets taxed on income from a source in South Africa. And if there are any special non-resident sections, then that will apply. From an Act perspective, basically what the Act says in section 9H is it tells you that 1 year ends and another one starts. So basically what happens is March, April, May, June, July, August, September, October, 8 months. Your first tax year is 8 months and your next tax year is 4 months as a non-resident. I know it sounds strange, how is it a tax year? It is a shorter tax year. Okay, that's the theory behind it, but just be aware of it. It will still all happen in the period of 1 March to 28 February. Okay, so guys, that's what happens. Obviously, the other side of it is the same. If a non-resident becomes a resident, I'm not illustrating it here, but just let's just assume this is a non-resident becomes a resident. Right, same situation. During the period the person is a non-resident rules apply. During the period the person is a resident, the resident rules apply. And then at CTA level, this in my opinion is a great way of testing tax. By seeing if people understand the difference between the two of them. Okay, so in our next recording, we'll go into a lot more detail on what it means source, what source means, and all of these different individual sections for non-residents.